Fantastic.
Okay, so
Thank you.
without any more ado, thank you very much. Tyson Halsey, CFA Income Growth Advisors, Richard Gula, Argyle Investing, who's worked for some of the Boston billionaire greats. As I said, I believe we are beginning an inflationary cycle. And if you look at this chart going back to 1887, you see these deflationary cycles, which are correlated with a great stock market, ending in bubbles, followed by inflationary cycles. It is my belief that you had a great deflationary cycle from 1980 to 2000, a huge run in the stock market. But then in the 1970s and from 2000 to 2008, you had inflationary markets. Then you had a great bull market, again, in the equities. And I think we are now entering a inflationary market, which will favor commodities. And what's hurting the market right now, last week the markets saw some weakness, and that's basically the thesis that we all kind of subscribe to or listen to what the Fed said is, oh, we will go back to 2% inflation and then we'll start easing rates. Well, the reality is we got to 3% on the CPI last June, and then it stopped. And we're not getting the CPI dropping, and the economy continues to show much greater strength. And my fear is that you will see inflation continuing higher. And what we've seen is the Fed be wrong from time to time. They thought that we would have transitory inflation. That clearly was not the case. But in the 1970s, the Feds thought they had licked inflation and then started easing too quickly. And then inflation rose significantly, and interest rates got up to the 18% range or 20% range in Fed funds and 15% in terms of the 10-year U.S. Treasury. But what we see here is that the CPI has been ticking up, and that's what's causing problems in the stock market. Now, one way to look at the market, the stock market, is relative to the U.S. Treasury. And we look at the Fed model or the risk premium model, which is at 0.38%. And that level is actually starting to get problematic. The last time we had a crash in 2000, the great bubble, the great tech bubble, actually yields on the 10-year exceeded the earnings yield of the S&P 500. And what you're seeing is we're heading in that direction. And if you look at this bottom chart, here you have the 10-year U.S. Treasury, and the earnings yield on the S&P 500 is coming down. Another way to look at the market, and my point being is that I believe we're sort of in a bubble in terms of financial assets, in terms of the S&P 500, is that we are, the Buffett indicator showing the Wilshire 5000 versus GDP is very expensive. And, it compares to where we were a couple of years ago when the market peaked at around 2002 and 2000, but also in 2000, excuse me, 2020. Another way to look at the market, and this I think is very important, is Shiller has a nice chart of the CAPE ratio. And right now, the CAPE, which is a 10-year PE, shows us at 34. Now, that's actually higher than where we were in 1929. And the reason you could justify the high PE to some degree was the declining interest rate environment we've had since 1981. Well, now that declining interest rate environment has disappeared. And while expectations were, again, that we would see lower and lower interest rates, that's going away. So that's a problem. Basically, here is a picture of the 10-year U.S. Treasury yield, and you see it in 1981 up over 15%. And basically, I believe that psychologically there's something called recency bias. We grew very used to an environment of declining interest rates, which favored stocks, it favored bonds, it helped real estate, and it got to a point where interest rates went from 15% to 0.5%. Then they rallied up almost to 5%, and everyone said, oh, they're going lower. We've licked inflation, and everything will be fine. But the reality of it is no. We're seeing inflation. We're seeing rising commodity prices. We're seeing wars break out all over the place. And the 10-year US Treasury at 464 is heading in the wrong direction. This is a problem for equity markets. And here's another problem structurally. The interest that we're paying on the $31 trillion in debt is going up. Because we see a rotation, one ratio that I like to track is the ratio of the Goldman Commodity Index to the S&P 500. And what you see is that it peaked in 2008 with oil and then bottomed in 2020 when actually you will all recall when oil was traded negatively in the futures market, maybe $12 in the physical market. And then we actually had a great rally in commodities from 2000, early 2000 to 2022, when with the Russian invasion of Ukraine, commodity prices spiked. Now we've had a big correction, but it is my belief that now we're starting to see commodities again start to advance. So here is a picture of crude oil. It looks like it's ready to move higher. In this previous inflationary cycle of 1999 to 2008, you had a big move in oil. And I would expect that there is the potential for oil to move a good bit higher. You know, we had decades of underinvestment in oil. There's a big push for ESG and electric cars, and everyone decided that renewables could replace fossil fuels. Well, that's proven to be a fallacy. We also have geopolitical issues, Russia, Ukraine, Iran, Israel. All these risks could force oil prices much higher. Now, we don't think it's just oil. We think it's commodities in general. And one interesting commodity, and I spoke about this last year at one of Marty's events, was gold as an attractive alternative investment vehicle. And one is it's a classic fungible store of value. A lot of people take great comfort in Bitcoin and cryptocurrencies, but there is real value in gold. I think in a period where you're uncertain about currencies, gold makes sense. Gold is being bought by all the central banks internationally. And gold, we had a huge move in the 1970s from 35 all the way up to 677. That was 18-fold. And then again, you had from 1999, it was 256 up to 1800. That was a six-fold move. I would not be surprised to see a 2 or 3, maybe even more, but call it three times off the low of 1,065. You could get to 3,000. And I think that that's consistent with commodity stocks, precious metal stocks doing well in an environment post-bubble. And that I think fits with what we're seeing.
Hey, Tyson,
Yes.
I got a question. Are you suggesting that we buy physical gold or paper gold?
Either. It doesn't matter in my mind.
Or miners?
I mean, right now, physical gold is going up, and actually the paper gold is not. There is a lag. I see that as an opportunity, but I think that if you look at the cycles, both will succeed. And I would say that there becomes Wall Street's like a herd. They find a theme, they buy it, take it to an extreme, and then it blows up. 60-40, I think, represents that. And one of the things about 60-40, you go to a financial planner, you're 65 years old, you got your retirement plan. What? Well, 60% equities and 40% bonds. And why? That's worked dependably, over the last 40 years. Well, I think if you look at it, one, it looks like a big parabolic move. Secondly, compare it to where it started, let's say in 1981. At that time, the earnings on the S&P were about $15, which led to a PE, I'm sorry, that should be PE, price earnings ratio of about 7 times, and the S&P 500 had a dividend yield of 5.4%, and the 10-year Treasury at that point was 15.5. Sure, put 40% of my retirement plan into 10-year Treasuries yielding 15%, and S&P yielding, earning at a 7.5 yield with a 15%. Yeah, I would do that all day long. I'd probably even margin it. But my point is, at this point today, where we are, we're not even close. All these things don't make sense. So what I'm looking for, and here's a chart of the S&P versus the NASDAQ. You've had this big move in the NASDAQ, and I think a lot of that pushed by the mega caps. You know, we will see a fade here, not necessarily a crash, but I think that as an alternative to the 60-40 as a portfolio manager, I think there's a very compelling case to be made for cash, 25%, commodities 25%, stocks 25%, and bonds 25%. And so this is me, been in the paper, won some contests, write a bunch on Seeking Alpha. You know, I have an RIA here. We're going to start with Richard Gula. And there's an expression when I used to be a broker at Merrill Lynch and Alex Brown back in the 80s and the 90s, is the charts sometimes tell the story before the fundamentals become obvious. Richard Gula worked, he set up the Fidelity Modern Chart Room working under Ned Johnson doing special projects. And he worked also for Dean LeBaron, another Boston billionaire quantitative analyst. And he's going to show us charts. And these are charts that he shows to his customers, the Fidelity managers. Rich, go ahead.
All right. Can everybody hear me okay?
Yeah, Rich, sounds great.
All right, good. All right, very good. I actually have a much blacker past than that, but I'll just give you 30 seconds. That I began at Putnam when we got a load of 8.5%. So I still miss those days. I worked in a battery march, and I revamped an international fund that grew to $1 billion, and it tied the Fidelity Overseas Fund in 1990 in terms of risk-adjusted returns. And we did it by grossly underweighting Japan in that era. You might remember Japan was something like 65% of IFA. And I always volunteered for things no one else wanted to do. So I ended up in Latin America building an emerging market fund for Dean LeBaron, which actually was quantitative, was Brazil, Argentina, Chile, Mexico, and we hardwired, I think, one Venezuelan stock. And the common threads here are that I'm an old-fashioned contrarian value person that appreciates growth, I guess the best way to put it. And the quantitative disciplines on top of good trend analysis usually enhances returns. How about that for a statement? Although I worked for Oxley International for a bit. For Walter Oxley, was highly successful as a pure stock picker, and he had a picture behind his desk that said that markets seldom reward economic virtue, and that was 1992, and it seems like that's still true. But that all said, the current market has it's been influenced the most by the crash of the financial stocks in 2008, 2010, the movement on the part of the Fed and various government administrations to save various institutions with pumping liquidity into the system. Probably the hero of what we're experiencing right now is Mario Draghi from way back, who convinced everyone that negative rates were a good idea. And on top of this, the SEC quietly watched as the ETF universe exploded, and hard to believe that Larry Fink is sort of the kingpin now. And that's not a comment on his skills, because obviously they're considerable for asset gathering. But ETFs are pricing your stocks, quote unquote. And I'm that's going to be a very difficult mechanism to deal with as we go forward, because I still would like to know what happens on a day where futures open down overnight over a weekend, down 5%. And so you have 2 or 3 down days. And then on Thursday, everyone hits their mobile app at Schwab or Fidelity or Interactive Brokers, and they sell their index funds. And I just sort of would like to know who's going to be on the other side of that. But that said, the issues right now that are causing, I think, just a shifting of this liquidity. Nothing has come out of this market that I can see that's been put in from 2015 to 2020. So we'll just see the pictures here. You'll see a V under different parts of the price chart. Those are just marking off what I call junctures, that what's become essential to understand the machinations of the market over the last 5 years, especially.
So we're looking at the XLF, right?
You're looking at the
That's
XLF,
financial.
and you'll see there's an X over the first V. That's if you, as you go through all of these charts, just keep firmly in mind that 2020 low was probably the beginning of a bull market rather than leading to a bear market that everybody, I think, mislabeled, that showed up when the Fed began to raise rates sharply. And you can see that there was a great entry point there on the financials. Now, when you give financials a chance to make money with interest rate carry, if you will, they haven't done much since back in 2021, at least as a group. And realize the reason to look at the ETFs is that if you walk in with a $5 million pool to most of the firms, you'll get an ETF portfolio, I believe. You're not going to get individual stocks anymore. So you could say, yeah, but JP Morgan did great. And so you bet the horse and the jockey, and Jamie Dimon's the best. And that's true. That would have done better than this chart. But most people are been told that diversification matters. If you watch the NBC and watch all the ads that State Street spiders run incessantly. So, but the first thing that's happened here is that as you sit with rate cut phobia or expectation, there's the stalling out. These are all monthly charts for the most part. Next chart down, XLE, which is energy. And energy, of course, was thrown out by almost every college endowment on the basis of ESG considerations. I think Brown University led the charge, and the president removed all of the energy stocks from their portfolio. And as an old manager, beating an index minus a sector is pretty difficult, especially if the sector does pretty well. That's still in play, and oil is obviously better than the stocks right now. But that I would say that this is still at that juncture at the same time in 2020. It looks kind of similar to the XLF, but to my eye, when I do the individual stocks, which is what I would do for the Fidelity managers, we're looking for, the best quarter to half of any given ETF, given a market cap consideration. And I'm sure you all are well aware that inside the institutional world, you're very much market cap constrained. You're either large cap, mid cap, or small cap. And it's hard to go, you have to have two of those touching. You can't jump from, you can't have small cap and a large cap barbell, except maybe in the contra fund over Fidelity, although I don't know that for sure. The third stock begins to show where the problems are. There's the don't forget
that's the real estate sector.
That's the real estate. That's the select real estate spider. Realize that when you're looking at this and it's a monthly, these are trading 99 to 150 million shares a month. It's not like real estate a REIT fund would be that specialized in the world of IRA investing, as I would call it. And I've blown up a little bit to see what's happening currently. I think that there's the primary theme in here right now is that there's a problem out there in the mortgage CRE world that has still been kind of shrouded publicity wise. There's plenty of commentary that there's problems in the commercial real estate. But this chart looks to me like it wants to break down hard. So in the quote unquote old days, pre-COVID, and maybe even during COVID, we could expect the Fed and the various white horse folks to come and save you. I'm not sure that's on the agenda in an election year. So Go down to the next chart. Keep in mind that, so you got a problem in REITs. You've got pretty much extended technology, but I would say that there's nothing that's in the technology world right now other than NVIDIA, which is so overdone, that would suggest that this isn't a positive place to be. So, but you would have that weight, but you might be taking some money off the table if you're doing an asset allocation. Next chart down is this is troublesome. I'm getting
This
into
is
the
the
camp
tech.
that
This is the tech ETF.
what after tech XLK, the next one down is XLY, and now you're looking at consumer
You're one slide
discretionary.
behind.
I'm
Right.
sorry, we're behind. All right. So you got the consumer discretionary.
Oh, I see. Yeah. I'm looking at charts on my pad here.
Okay.
I'll correct that immediately. I got to just put it sideways. There we go. I can see now.
So you see what this? Okay.
There we go. The odd thing about consumer discretionary is that when you got into the rate raising phase, the asset allocators came out of this hard and have not really come back. And so you've got a recovery, but the recovery is now muted. And if you break apart components of this, we'll take the ETF as a pool, a valid pool for stock selection. There are some real lemons out there like Nike, name brand companies that are at a global presence that are not doing very well at all. And at the same time, Lululemon has run into some trouble, and there's a resurrection in Target. But I smell a recession being played here by the asset allocators. That's what this behaviorally, that's what you're seeing, rather than my saying, if I digest all the people on CNBC, et cetera, for a week, that my conclusion is that there's a recession. I do think that
13 slides in 5 minutes.
Yeah, we can go fast now. Next slide.
Schwab REIT ETF.
Okay, the Schwab ETF is why you want to double check that against the other is that Schwab has its own set of funds that they compete against, and that's going to be, they're saying the same thing. They're not putting people into their view is there's a problem here. Next slide.
Blackstone.
Hold on. Blackstone's got a big CRE exposure, but it's largest and best capitalized, if you will, of the funds. And it's hovering right now. I'm guessing that they don't have the same issues that if you go to the next chart, what old Boston Properties has. Boston Properties has got a serious issue here. Go down to the next. And then you go to Blackstone. Unfortunately, they also decided to come up with a mortgage trust. That's also showing a major problem. Go down to the next one, and here's the one that I think is going to cause the problem. This is the large mortgage-backed security ETF. It trades extremely well. I've seen a number of presentations that indicated that their 3 to 4% mortgages are buried in this, and there are probably not very good bids on those right now. And if there's been a constant liquidation in this fund at very high volume, if they get down to those unbidded or non-bidded mortgages and have to do something about it, that could create a chain effect. There's got to be a chain effect into the derivatives markets and into the hedge fund world. And so that's the core problem that's trying to be worked out. But the global markets are pretty smart. Go to the next. So they said, well, we'll go buy commodity basics, which looks like a secular uptrend to me. Then go to copper, and you say, well, let's get a little more selective. And that's a very strong participation. And you see a big spike in volume in the last couple of months in the COPEX. Then go to the next.
That's gold.
And there's gold, and gold looks the best. Gold stocks, not so much. I couldn't find gold stocks that seem to match this. There are numerous webinars coming out right now that speculate on who's behind all this. And the question of that was asked early on about physical gold versus paper. If you buy $2 million worth of Krugerrands and you guess that they're 5 to an inch, I think you need something like 14 feet of PVC tube to bury that in your backyard. So with that.
Okay, now we got the gold miners trust, the GLDM. So should I move to the next? This is Peru, EP. Do you see the chart, Rich? Have I jumped ahead?
Tyson, we lost Rich.
Oh, wait a minute.
Rich, I know where I am. Where are you? On the slideshow.
Oh, I'm on the small gold trust, the GLDR, I believe it is, or GLDM.
Okay, GLDM. Okay, so yeah, that's moved up.
Okay, that's where the public is. It's trading 167 million shares a week, a month. I mean, it's very liquid. Last two, you say, well, there should be some further movement here. You can see it in copper. In first, Peru is as an ETF, and Southern Copper is a stock. So if you kind of keep in mind that the two strongest charts in here right now are Southern Peru copper, SECO, and the gold, the two gold charts. So in summary, you've got plenty of confusion on the valuation side because ETFs are pricing everybody's stocks. You've got plenty of confusion on the interest rate side because the Fed will jawbone continually. And the secular trend coming off the 2020 low is very much in favor of some kind of commodity cycle. And whether that's inflation or not, we'll find out.
Did somebody log in here? You have to turn your sound off.
And this
Go on mute.
is from this device.
Should probably decline the call.
Hold on a
Press
second.
N. I mean that.
Yeah.
Keep on going. Keep on going.
Okay.
Let me.
Decline.
Okay, yeah, the incoming call.
This might be the.
I said keep on going.
presentation.
Yeah,
Mark
that's
D'Souza,
Yeah.
please mute yourself.
I'm trying to.
Okay, go ahead, Rich. There
We
we
got
go.
about 8 minutes left. Keep on going.
Right.
Oh, we have 8 minutes.
That's it.
So let's take some questions from the audience.
All right. So any questions here? Because I have lots of questions. I mean, you heard Alfonso's perspective. You guys are heavily into commodities. You know, I guess, and a lot of people are saying that, you know, we had these rolling recessions and sectors by sectors over the last few years. It seems like we're out of the woods. Would you agree with that?
What do you mean around the woods?
Out of the woods. Out of the woods.
Which woods?
Are we no longer looking at a recession in the near future?
Well, I think that problem that's being questioned, which is why interest rates are not declining. But part of the problem is inflation. And so that's really where the problem is. The way I see it is maybe the economy actually surprises and we have inflation, and that creates a real mess. And I think that could be further enhanced by rising commodity prices. The reality of it is inflation is not coming down the way everyone thought it would. I never understood why the Fed thought it would, because prices of everything have gone up. They're pushing higher labor prices, higher services prices, higher commodity prices. And, you know, as long as you're paying more for natural gas or more for oil, that's going to feed its way into everything else.
So some people have said that, you know, Bitcoin is a way to hedge on inflation, but a lot of other people are saying that Bitcoin seems to be correlated to the NASDAQ. Any thoughts on that?
I think that there are two pools of money. One is one that recognizes, one is speculative money. They've dumped a lot of money into the economy and into the markets, and that's chasing the NASDAQ because it's going up. and it's chasing Bitcoin because it's going up. And but I think that some people would argue this is the new gold and all that. There are problems. I think the criminal issue with Bitcoin kind of limits it. That's where I see an argument for gold. Rich, do you have any comments?
Bitcoin is it's a non-asset asset, in my opinion. The arguments about store value are pretty tough to swallow. And the IRS will decide whether it's taxed as property or taxed as short-term capital gains. But blockchain transfer is huge inside of the banking world globally. I have a very close Chinese friend who ran part of Reuters in Asia, and he said 5 years ago he could move $10 million across China in an hour. And I think to move it from New York to London takes quite a bit of time. But Bitcoin is going to create a speculation problem because it is, in my mind, it's far too opaque. It's not quite as opaque as gold. I mean, if you think about it and you look at the two gold charts and then you say, well, central banks are buying, I'm not sure what that means to me. But you can create manias very easily right now in the market. And a very good over-under bet, as they say, would be whether NVIDIA or Bitcoin would fall 50% first.
That is a good bet. Great, fantastic. And so, Tyson, anything outside of commodities that you are favoring, or do you have a worldview on economics? Europe, the West, the global South, that you can summarize in 30 seconds or less for us?
Yeah, I think we're living in an entirely different environment today. The case for cash is real. At Interactive Brokers, you can get 4.8% in a money market and take no risk. And people used to say you had to be fully invested. I think that's wrong. And I think that having money in inflationary proxies makes sense. Now, I like that, but I think Alfonso laid out a very supportive case for why commodities make a lot of sense. So allocating to commodities and cash and really cutting back on stock and bond allocations, I think is good, responsible fiduciary asset allocation.
I would add that there's good asset flows toward emerging market, and the funds, and both. But right now, if you own both Poland and Argentina for the last year or two, you've had pretty good performance, as well as the Stocks 50, it's the S&P 100 minus technology. So there's global flows at work here, and I would not reduce exposure, say, to Germany, which has now also made new all-time highs. So we are still in a full-blown asset boom. I don't disagree with Tyson at all, that if you get too vertical in these images, there'll be a downside that'll be quite dramatic. Just bring back memories of what stocks look like in 2000 to 2002.
So, I just have one quick remark, and then we're going to get a couple more questions. So in 2010, the Fed started cutting rates and whatever, it just kept on cutting. And we asked every meeting we had in New York, well, when was the Fed going to increase rates? And the year, month after month, people would say, 6 months, 12 months, they started increasing rates. It never happens. And we stopped asking the question. So when's it going to cut rates? Tyson, any thoughts?
He's not cutting rates. He can't. Unless Biden calls him up and says, you're not going to keep your job if you don't cut rates. And
So another economic question, at what price of oil, do we go into recession?
You tell me what happens in terms of the Middle East crisis and I'll tell you where oil goes. Higher oil.
Israel retaliates, Iran retaliates back.
I don't even
Look,
think.
I think you could
Strategic
see-
reserves
I-
running out.
I think you could see higher oil prices, although the Saudis may come in and try to cap it at 100. But
Interesting, yep.
I think that there's a risk that it can spike higher, and that'll be a problem. And there's a political element to it. I mean, we saw what happened with the strategic reserve. Oil prices started going too high, it hurt at the pump, and suddenly we emptied it.
I think Mark Kyle has a question, Mark?
Well, I was right on the point. The strategic reserves are nearly empty. I think by the end of the month, they said we're gonna run out of our strategic reserves that are keeping the price at the pump low. And how's that gonna play into everything?
It won't be a problem as there are no threats of war.
The
Oh,
only
you are
caveat
clever
I put in,
person, Tyson.
I don't think that's exactly right because
He's being
meant to lower the
facetious.
price at the pump.
Now you're trying to look at Tyson's face, he's being facetious. Rich, your comment?
yeah, just the caveat I'd put in on rate activity is that I didn't go very much into the regional bank images, but the Boston area, there were 10 major banks in 1990 that are run here, and none of them are run here anymore. And the largest of the regionals, the Eastern Bank, is fallen down below its offering price when it went public. The odds are that either there's exposure to commercial real estate lending, or the areas that I did. I was also chief investment officer at a $4 billion bank, registered SEC investment group. And I can tell you what banks like to do is that they always bite on the first down because they see everything being valuable or more valuable or good entry points. And if they keep buying down into other loans that are non-performing, the Fed may have to step in and save the system one more time. In an election year, that I can't imagine what that's like. Last thing, please realize 5 Fed governors have been disappeared off the Fed in the last several years. Several because of supposed trading. The keeper of the Fred database went over to Purdue to run the business school. And Lyle Brainerd, who was on briefly, has ended up in the administration. I think that inside the Fed, there's some questions about what data they look at and what to do. And I think that they're getting closer and closer to the rock and hard place here. They may have to cut rates to save the system or realize that they've put more reserves, however they would do that. That's going to increase inflation. So in an election year, that's probably not going to be appreciated. So don't go away now. The fun's just beginning.
Yeah, great job, guys. I think we're in a very interesting time. I think that we're going back into economics that are very similar to the 1970s. And I think that, I talked to Alfonso about this, migration of economic power to the global South, which fits into your commodities perspective, right? Whereas 20 years ago, the industrialized world was 2.5 times greater in economic output than the global South, and now it's 1.5 times greater. So the trend's not good. But we're going to keep on monitoring it. So thanks so much, guys.
Thank you.